Right. We got people starting to roll in. Paige and I are just going to be eye candy for all of you for a couple of minutes while we get a good solid group online, and then we'll get cracking. See a lot of friendly names on here. Everyone, as you're rolling in, we'll probably give just a couple of minutes to let the stragglers log in, get their Zoom stuff situated, and then we'll begin. Give it one more minute, Paige.
Oh, good.
I'm glad we color coordinated for today's conversation.
Yeah, I was gonna, wear the same shirt, but that would have been weird, so I had to change.
I'm a little too chest hairy for what you're wearing. So
For the best of our viewers.
yeah, I don't know how that would work.
We've got a live office environment today, so I hope the audio comes through okay.
You sound great. If you want to belt out a few bars and sing for the audience, I can definitely test it.
I neglected to speak at my high school graduation in favor of singing.
Oh.
That was a number of years ago now, but that was how terrified I was of public speaking at one point. Obviously, a lot's changed since then, and we're on for Wicked.
Not quite the same level of fear.
No.
All right, everyone. We will we'll get things rolling. So first and foremost, thank you all for joining us for episode 3 of IB Thinking About. Today, I'm absolutely delighted to have Paige Pitcher, who is the head of strategic partnerships for Modern Ventures, joining me today. Now, Paige and I have known each other for several years. We go back from my days schlepping digital twin technology for ThoughtWire at that time, I believe. Paige was on the innovation team with Heinz several years back. And, Paige, for those that are logged in today that have not had the delightful pleasure of getting to know you over the last few years, why don't you tell them a little bit about yourself, tell us a little bit about Modern Ventures and your role with that organization.
Sure thing. Yeah, I am really privileged to sit on this side of the table now, having started on the other. So my early career was in urban planning and as an entrepreneur myself. I started a company before I had graduated undergrad. That company developed affordable housing in my home state of Utah, and it's still going strong today. But I kind of fell in love with the rest of the industry, wanted to learn more, and did my master's at MIT in real estate development and really got hooked on the T of MIT, and worked with Heinz, as you mentioned, in their inaugural Office of Innovation team. So they're investing on their behalf in corporate venture funds and direct investments. Really became a natural path to where I am now, which is Modern Ventures in Chicago, sunny for the time being. So we are an early stage venture fund that's about 500 million AUM. And we invest in companies that support the real estate industry and adjacent industries, including insurance, fintech, and sustainability. So I get to work with founders every day here, which is my favorite part. We have an active portfolio of over 80 companies, and about 30 of those are investments. I might explain a little bit more about that later, but Modern is really investing in companies that are globally minded, but usually headquartered here in the States.
Very good. Well, I'm excited to have you joining me for this conversation. We've got a lot to unpack, right? So I'm very excited for today's conversation because I think with the way things are going right now in our market, the things that are impacting real estate, the things that are impacting PropTech, it's a very volatile time, right? It's a lot of challenges out there. For many, this is perceived as opportunity. We've got a number of very interesting topics and questions to explore with each other. Looking forward to hearing some of the questions from the audience at the end of this. So the topic of today's conversation is navigating volatility in real estate and PropTech. And so the way we're going to structure this is we've got some things that we're going to talk about, the two of us. Once we hit around that 25-30 minute mark, everyone, I'm going to throw some polls out there, looking to see how those are responded to. And Paige and I will put our 2 cents into those questions. And then at the end of this, we're going to open this up to the audience. So feel free to, when we get to that point in the Q&A session, ask us some questions. We'll pick a couple while we still have time allotting and address those as well. So let's kick things off, Paige. Now, there is, I think a lot of people, but myself included, the people that are in the audience spend a lot of time navigating LinkedIn, seeing all these articles coming out. And I see different articles with mixed messaging around VC activity. We read one article where startups are disappearing at an alarming rate. We see another one where all of a sudden there's a new fund spun up tethered to something like climate tech, and there's a lot of money floating into that sector. So, I mean, what the hell is going on? Help us understand what's going on. What are you seeing from the VC seat, and educate us. What are you seeing from your side?
Well, we're starting off with a softball question. Thanks, Kyle. It literally changes daily. That's why we started a new sort of series here called the Modern Minute, because when we were staying on top of the goings on with SVB and other failed banks, we realized that the situation really was changing minute by minute. But this is a product of what happened last year. I'm going to call it like the Great Reset, or instead of recession, because it was a correction. And we spent all of 2022, about sort of halfway through the year, things really started to slow down. And a lot of that was driven by that SPAC and IPO boom that a lot of companies go public with misaligned economics.
Yep.
And so we saw that slow down the latter half of that year. However, here's the other funny thing that happened in 2022. More capital was raised. So deals are slowing down, and yet dry powder is stacking up. So it's an interesting environment right now where now more than ever, especially with venture debt being frothy at best, there are opportunities for investors who are still willing to do good deals to get good deals. Same size check and more maybe presence on the cap table. So I think that is the bit of a catch-22 that we're in right now, that while the VC world at large may be seeming to step back, there's a ton of dry capital available. Modern was maybe one of the few who did a deal in Q1 this year and got that through. But the idea is to buy low, sell high. And this is a perfect environment to step in and really support the founders that are growing and growing responsibly, that are especially those that have runway through the end of next year is kind of what we're recommending at this point. So well, I know
you're touching on this, right? And so we've got some PropTech leadership that's joined us today and is in our audience. And you mentioned SVB, having issues. There's looming speculation that we're going to have some other banks that are going to run into some significant troubles because they haven't hedged their debt and their risk posture. So we may see more of this coming up. Now, if you're a founder and you're still looking, you need additional runway, you need to go and seek additional funding. If you were to give any key advice to these founders, these heads of these early stage young PropTech entities, like what would be that key advice that you would give them?
Yeah, I mean, apart from multiple banking relationships, which is always a good policy, the thing I mentioned earlier, which was ensuring you have enough runway through 2024. And that may come from things that are unfortunate, like RIFs. That may come from just simply limiting your R&D or your roadmap spend. It may come from just making sure that you're really focused on converting those pilots to paid engagements, that you're focused on upselling in your current customer base. Right now, we're really working with our companies to limit their cash burn Make sure that one bad hire at a large corporation may not be the end of the world. One bad hire at a startup sets you back months potentially. Making sure that you really nail those hiring strategies for a healthy growth cycle. A lot of, on the funding side too, Kyle, a lot of companies are continuing to extend rounds, open up convertible notes, and there's absolutely nothing wrong with that. And so that's what we're seeing in terms of companies who still may need a little bit to get through the rest of this year. There are other rounds that are out there being, I mean, if we can get there on price and valuation, which even in Q1 and Q2 this year, it's a very, very different story. Sometimes the drop is almost a third of the company value. If we're willing to get there on price, I think there are deals to be had. As we talked about earlier, dry powder is everywhere.
Yeah. Well, and you had mentioned, and I've experienced this, firsthand. I've worn the VP of sales hat for a couple of startups, and that is one hire in particular that is extremely volatile. If it's the wrong one for a young company and they're going after their first VP of sales, if it's not the right VP of sales, it's setting you back substantially. It could be a massive, massive impediment, both on growth, future valuations, being able to get additional rounds of funding. That's a whole nother topic that we can get into. How do you make sure you're hiring the right people? But well,
in addition to understanding the right time to hire that person, founder-led sales go on for much longer than the founder ever wants, but it's so critical at that early stage that may be the first person that you're hiring at a Series A, but doing it too soon and stepping a little bit too far away as a founder, it slows things down, not speeds them up. So being very careful about hiring strategy.
I agree for sure. Now, you said that Modern Venture is, still actively doing deals. Help me understand a little bit, where the different types of PropTech entities, like which ones are Modern Ventures mostly focused on? Which ones do you seek after? Are you going after mostly climate tech, fintech? Like, what are the different areas that Modern Ventures is really focused on?
So over the past year, we've deployed well over $40 million in capital. Again, these are early stage companies, so these are, not enormous checks, but we've done plenty of deals in the past year. About half that's been in the last 6 months, in the last, 3 quarters. So we're typically investing at that Series A stage. So that's companies for us that have about $2 to $20 million in realized revenue. And that can be, I think last year, the median ticket size for a Series A raise was about 15 million. So we lead, we follow, but that means that we're not really applying those sort of 10 to 20x multiples on their revenue numbers any longer. And frankly, we exercised enough restraint last year that we didn't either at that time. So we still focus on that real estate being our primary vertical and its adjacent industries. ESG or sustainability is one enormous opportunity. And although PropTech investing being like the most narrow definition, SaaS serving real estate, PropTech. The most narrow definition was down 38% from 21 to 22. So it topped out last year at about almost 20 billion. We were up at about 32, 33 before then. Yeah. So yes, that's slowed down. The other areas of opportunity that I think a lot of folks are turning to, and you can see it in the numbers, is climate tech. And so watching those carefully, where we want to make sure we're not repeating 22, where valuations and step-ups got so much ahead of their skis that we had to pump the brakes a bit, because I could see that pressure to grow and that pressure to overvalue being pushed into the climate tech realm, even though we're still really excited about that. Another stat, which is kind of funny, is last year, 1 in 4 venture dollars went into climate tech. Like that is the rate of growth that we're looking at here, because it's coming from, and it is centered around many different sectors, which we love that. We love the outside in. It's coming at us from the energy and from oil and gas. It's coming at us from industrial and manufacturing and last mile logistics, real estate being 40% of the world's carbon footprint. There's a reason why that much capital is flowing into climate tech. It's not a bad thing, but I think we want to exercise the same sort of discretion that we had last year. So we're hunting there. There's about a third of our portfolio right now directly addresses ESG, environmental, social governance at some level. Which I think for us is about right. So we'll continue to open up for deals in that space. And we can talk on trends a little bit later about things that may not be here ready to invest just yet, but we're tracking for the long run, because we know that technology, maybe it's 18 months down the road, maybe it's 10 years, is something that we know will be tectonic.
Well, we can go ahead and jump into that. I mean, looking, you have your crystal ball, right? So let's get your crystal ball out. So looking at the next, 1-2 years, I go to conferences very regularly, and generative AI is all the buzz and everything. I was very quickly over that conversation with the last conference I went to, because I think there was about 6 or 7 sessions just on that, and it's just a whole lot of fluffy speculation. But I think there are going to be very practical applications of it. I think if it's done very well and it's structured and it's secure, there's going to be a lot of impact in real estate leveraging that as a component of additional technologies and innovations. But what are some of the things that you're seeing in using that crystal ball that Modern Ventures is going to be excited about over the next year or two?
Yeah, I love this question because what we spend our time thinking about often is the future. So every VC should have a crystal ball. Not all of us do, but if I had one, I would say here's some things that we find really, really intriguing and interesting, because we can learn from other adjacent industries as well, either taking stuff inside real estate and out, or outside in. Robotics is one. So we just did a webinar this morning for CBRE that was covered Icon, which is robotics for printing an entire building, and robotics on the consumer side, helping hospitality and multifamily properties with robotic cleaning. So that's one where, and the stat is this: over the past 5 years, over 70% of the robots in the world were targeted toward traditional industrial manufacturing. That's more like half and half now. Yes, that will still continue to play a role. Robots are becoming more popular in the US, of course, APAC leads, but we're offering spaces for them inside our properties. We're offering spaces for them to deliver to our properties. We're using them on job sites. We're laying out wall grids. We're site grading construction sites. And I just think that robotics has a lot of more room to grow outside of the traditional industrial manufacturing space, especially as we're facing a ton of different pressures in the labor market in the real estate industry in particular. Engineering, janitorial, property management, and beyond.
Now, how long do you think it'll be before we combine generative AI and robotics? And now we're here we are at Terminator 1. Is that 5 years, 10 years, 15 years?
Yeah, general AI that's like, hey, I created myself up, I'm live. Now what? I think that we are at a really interesting precipice of this moment, and the 6 month pause that was requested by certain professionals out there, I think, is probably prudent, because right now we don't really have a great way to regulate the misinformation or the hacking that everyone's heard about. So yes, ChatGPT has taken over the headlines with both warnings and promise, but 3 modern portfolio companies I can think of off the top of my head are using generative and large language models to serve their customers better. Yep. This helps, agents write listings. This is helping buyers understand the short-term rental market for the property that they're about to invest in. It is used across our portfolio, and it has been for quite some time. It's just now what changed is ChatGPT has given the general public an interface that makes it easy. But for our companies that have been using it, I would say prudently, intelligently for the past 5 years, like Verse, which is automated text messages and follow-up for leads, it's been around for a while. Yep. So a few others that I think are fun. Absolutely looking at metaverse and XR. That's one that's maybe a little bit too early, but we're finding some, small pieces of the market to engage in there. I think that the other piece of generative AI and large language models that has not really been tackled is its ability to speed up the paper-based business of real estate in legal tech or contract automation. There's a lot of room to run there, I think, given, our 90-page leases and our huge property management agreements. There's a ton of things that are still largely paper-based in this industry. And I think that that's one nexus that I haven't quite seen come together yet, is what we're seeing and experiencing with large language models and what we can do with all of our paper. There's probably a million more. What do you think, Kyle?
Well, I see a lot of business process optimization with it, right? Stuff that you're talking about. And I think about real estate. I think about, complex calculations that is very prone to human error, like Camrex in retail space, right? I absolutely, the areas that, throw up red flags for me when it comes to that particular technology is, anything that's IP based, right? If you're, a developer and you're putting sensitive, proprietary code and things like in there to help optimize your code, now you're just giving carte blanche access to stuff that's proprietary. So like, that's the stuff that just gives me a red flag. But I think you use the appropriate terminology there, and prudent and smart ways of using it without exposing your organization to things like that and giving away your IP. I think it has a lot of applicability on business process optimization. Things that are very manual, things that are very tedious, I think we're going to see light year advancement, especially as the efficacy of the generative AI gets better and better, right? When it gets into that 95+% of efficacy, I think there's going to be some very cool things that are done with that. I'm very interested to see in the electronic vehicle things, both from a political perspective as well as from a infrastructure and technology perspective, because the technology is very cool and it's there, but how well is a continent like North America going to be able to adopt it in a meaningful way that's going to expand across the entire country without politics causing hoopla and all of those sorts of things. So I mean, that's one that is interesting to see, and I think it's a very polarizing topic for a lot of people. But I think with all of the stuff, anything AI and the legitimate application of AI versus a lot of fluff and nonsensical applications of AI, which is what you hear a lot of the time, which a lot of times is like just glorified analytics, at least in our industry. I'll be interested to see how true machine learning and AI starts to really infiltrate our industry and the types of results that we're going to see from that.
So just to be front for just a moment, I think less than 1% of parking spaces in the US are electrified. To be able to, and yet 5% of all new vehicle sales in this country last year were electric. Countries like Sweden, it's 95. And that was really from the policy push. So we know where we're headed, and every year BCG ups the ante on its forward-looking predictions of EV vehicle adoption. Every year it gets higher and closer to where we are today. So there's a lot of work to be done there. That's why we invested early on, I think 2019, in a company called Zeal. But electrification is happening from 3 different sides. It's about modernizing our grid. It's already happened in the automotive industry. There's a lot we can learn from there, hence EVs. And then at the building sort of asset or asset swap out level, how can we electrify buildings without sort of like doubling our energy cost on that property? So
the grid demand is going to be a key element of this, right? Is how do we adopt and improve our grid? You have California that's already struggling with it right now, right? So how do you scale that across the entire country and do it in a way that people are not going to have rolling blackouts in perpetuity, right?
You mentioned
connectivity. What's that?
You mentioned connectivity too, and when you're talking about things that are, your job is to harden the asset, and my job is to bring in all the IoT and open a few loopholes. Additional technology. So when you're thinking about connectivity, we talked a little bit about your owner first mentality for that, but I think that whether that's blockchain as a communication protocol, or whether that's LoRaWAN, or whether that's just simply owning the networks inside your building, I think that there is something in the future of connectivity that we have to continue to pay attention to. That's not stopping.
Yeah. I want to pivot and talk a little bit on some of the regarding PropTech, and from an owner's perspective, or even a large corporate who's looking to adopt technology, start looking at some of the risk profiling of a lot of these young PropTech entities, which from a VC perspective, you're evaluating on a day-to-day basis. But also from a head of innovation, a CIO, a CTO, a head of engineering, head of asset management, that's also evaluating technology on a regular basis to find out who are they going to trust, who are they going to invest in, who are they going to deploy at scale. Now, as a two-time VP of sales for a young PropTech organization, And then just as the nature of what I do and as a career, I talk to CEOs and founders on a fairly regular basis. And time again, I've heard the goal is really just liquidation event. Let's get as many logos as possible and let's get to a liquidation event and cash out. Then we're going to go and spin off our next prop tech adventure or new innovation or new startup. Now, if I'm on the landlord side or I'm on the acquirer side of technology, right? There's a huge risk profile when I'm looking at young technologies and their staying power and are they going to be here next year? What would be your advice to a company that's evaluating technology to make sure that they're mitigating that risk across these startups?
This is a perfect question given where I sit in the ecosystem. So I think of myself as having two portfolios to serve. One is the tech companies that Modern invests in and has a stake in. The other one is my industry partners and the chair that I used to sit in that want free pilots that are cheap enough but impactful enough to make a difference in their business. And so brokering those two different sets of needs and encouraging partners to adopt early stage technology where there is some risk, right? The protocols I think are is that I believe in Modern has a certain program called Passport in which industry partners can engage with companies that are new coming through this platform and this program at either no or low cost for a pilot. I believe that incentivizes both sides to pay for pilots. And so something as simple as getting both of your teams on the same page to engage in a pilot, even if it's a few $1,000s, is a great way to de-risk it because you're certain that they're bought in, that they're not just telling you something is on the roadmap when it's not, and that you can improve the product together. So early stage adoption needs early stage influence for companies. If it's working out and you're ready to roll from pilot to further implementation, maybe even portfolio level agreements, sometimes the best way you can de-risk it is to invest in it. And so I would say, look for other investors like Modern or other prop tech investors out there that are backing these companies because we have the financial data and we're the ones able and willing to support them from a capital raise standpoint, especially in tricky years like 2023. So look at who's on their cap table. If you have the inclination to ask them about their financials when they go through an RFP process, go ahead, ask away. You want to make sure that if you're a corporate real estate logo looking to adopt an early stage company, if you see other logos you recognize, you're among friends. Yep. That's usually a really good sign. Now, those friends might be what we're planning on for an exit scenario. When we invest in companies, we spend a lot of times underwriting different exit scenarios into what types of organizations. And so making sure that there is a market for that in the long run, because public markets, I think for the next little while are going to be not what we're underwriting to for sure. So those would be some, I would say, engage early on and try to influence the roadmap and make sure that you're paying for the pilot. If you can exert other influence or invest in the companies, participate in both the strategic and financial upside, there are, amazing returns to be had, and look for logos that are adopting the same tech. Mm-hmm. Oh, the last thing, Kyle, we talked about this. Don't try to drive the price so low that the company won't exist next year.
Yeah. I've been on the end of that a few times in my career. I've always been one to provide value over, being the cheapest thing on the block, right? I think that's a disservice to both entities, but no, for sure. Like it's a procurement team's job to get the best deal possible. But at the same time, you've got to enter into these arrangements, especially if you're looking at a portfolio scale. This is a partnership, right? And you have to, not trying to be cliche, right? But you need to be invested in the company and the technology company that you are looking to deploy. You should be invested in their success. Their success means that you're going to have long-term staying power and viability with technology that you're putting into your portfolio, and they're going to be more well-suited to support you, continue innovation, and driving to make sure that your properties are going to be the best properties out there. But if you're nickel and diming them and you're driving the cost down to the point where they're barely getting by, that to me is not the proper structure for a true partnership. Now, I'm going to piggyback that a little bit here. So, when you look at the state of the market. We talked a little bit about runways. We talked about, state of the market a bit. And as a byproduct of that is runways can get shorter if you're not lowering your burn rate, if you're a young startup. And I think this goes both for a small company as well as the larger companies out there, right? As capital has become more expensive, it's not like it was, 2-3 years ago. One of the greatest concerns I have, Paige, is how this is going to impact innovation, right? So if you have these young, innovative companies, or even if you have the larger companies, you're in a scenario now where these larger organizations are going to have to tighten the reins on some of their experimental projects, some of the tangential things that they're doing to innovate and really focus on their primary revenue streams. That's my take on this. What do you think around with the way the market is today, the way we see it going? What is your concern or what are your views on how that's going to impact innovation in PropTech, especially considering we're in an industry that has struggled to really embrace innovation historically?
Yeah, I think don't like fact check the quotes here, but I feel like we spend 1.5% to 2% of our budgets on IT and on technology broadly, whereas other stabilized industry is more like 12 or 13%. So we have a long way to go. If we're just barely starting to get off of, paper, manual, and word of mouth, and so that we can run our buildings remotely that we know we needed, thanks for the lessons learned pandemic. But if we start to shut off that tap entirely, I understand that capital needs to be moved in the right places in order to survive a high interest rate environment like this. But we can't really afford to slow down at this point. So it will be a bit of a hindrance in some ways, but there are still places in which tech budgets haven't decreased. I think we're just moving them around. Some of the easiest faucets to shut off, for better or worse, is marketing and focusing on sort of optimizing the clients that you have in place, be they, tenants, residents, or other. I think that stabilization is what a lot of owners and operators are focused on this year. And to a lesser degree, but although there are some pennies and nickels and dimes to be picked up, is in ancillary revenue generation and services from package delivery, EV charging, fill in the blank. There are ways to generate additional revenue, provided that your REIT structure allows for that. And then I think really there are others targeted toward OpEx reduction. And that's where we're seeing a lot of the sustainability and environmental plays saying like, hey, we may not be able to give you that, $1 per square foot or $1 per unit NOI boost, which is really where we want to be. But maybe the name of the game for the next 18 months is OpEx reduction. And anything that can really, and this is how we coach our companies that come through either our fund or our passport program, is we help them write an ROI from day one.
Yep.
And put to it. It's not just like, oh, we help with leads, we help with experience. That's not enough anymore. We need a number, be it hours or dollars.
Unequivocally agree with that. And I think as we look over the foreseeable future, right? I think in the past, I think some companies have been able to sneak by kind of fluffier value propositions, and we're going to reduce utility consumption by 20%. And I think companies are absolutely going to get much more granular on where have you done this? Who have you done this with? How many times have you done this? Can you actually show me quantifiably how you achieved this? And I feel like if you're in the PropTech circles, right, and you're pushing whatever solution it may be, if you can't effectively communicate what your ROI is, and this goes for us as well as a consulting firm, right? If we're not providing value that is directly impacting CapEx on new projects or redevelopment projects, or if we're not impacting recurring OpEx, not going to get the needle moved, right? You're not going to get those solutions in place. So as owners of real estate, as heads of innovation and workplace for large corporates, the focus has to be, what are you going to do as a PropTech vendor that's going to impact our financials? And I would foresee any product that is not directly tied to CapEx and OpEx reduction is probably going to go to the wayside and be deprioritized from any innovation initiatives. And
one call out there, especially to make on the risk side, is insurance premiums have been through the roof. Mm-hmm. Anything we can tie back there. I think that this is what I'm really excited about in terms of cross-industry collaboration, is at the end of the day, it may not be the banks holding the bag. It may be these carriers and our insurance policy holders. That there's something there when it comes to the massive amount of growth we've seen or inflation we've seen in insurance premiums and policies. I think anything we can do to reduce that risk and work with carriers and providers to prove the data points, to gather enough N that we know that by adopting X, Y, or Z technology, we have helped reduce the risk and premium on this property.
Yeah, and I think, one area where you see that just very prominent right now would be in building level cybersecurity, right? Where a lot of the carriers, they're not covered. They're diminishing any kind of riders or any kind of coverage over building level cybersecurity. However, the premiums are going through the roof. So you have landlords and owners that are finding themselves basically self-insuring cybersecurity. So that's a great example of that. We're up at around 35 after. So one of the things I'd like to do, everyone, is I want to pivot over into sending out some polls. Want to see what you guys think about some of these conversations. So I'm going to jump over into the polls and launch this. And once we've had a chance for everyone to answer, then Paige and I are going to put our 2 cents onto some of these questions. So I have launched that. So as we're going through that, give everyone a few minutes to answer. Now, Paige, we just got through Easter. So tell me, what was kind of your guilty pleasure on the Easter front? What were you stuffing your face with?
When you're doing like online orders and virtually adding things to the bag for pickup, I accidentally added not 1, but 3 bags of mini Cadbury eggs to my basket. So that was, a serial life consequence that I had to live with. And I definitely swallowed. So that would have been my answer. I think I added that to the poll there. So
I end up being the cleanup crew for my kids, for any of the candy that we don't want my kids to eat. And then my wife and I, we started this thing we did this back in Halloween, and it was, we called it the Switch Witch. So the Switch Witch writes letters to our children to basically let them know that the Switch Witch and the other witches in the community use the candy to keep their fires warm and to build their houses. And so the kids will actually go in there and take a gallon bag of all of the Halloween candy and would then they would donate it to the Switch Witch. And in turn, the Switch Witch would give them, $5, $10 to go to Barnes and Noble and go and buy a book or a little Lego set or something like that. But as a parent, that's that much less candy I have to worry about my kids begging me for on a day-to-day basis. And so when Valentine's Day rolls around, which again is way too much candy, and then Easter rolls around, again, way too much candy, there's always a little natural disaster that hits the Switch Witch's little town. And so the most recent one was a cotton candy tornado that just rolled right through and destroyed the Switch Witch's house. So she needed more supplies.
that's amazing. So where does the trade out go?
Where's what go?
Trade out. So the building supplies that they have given you in exchange for funding, you take that to work with you?
No, that just there's different areas that'll always like take the candies, like donations and stuff like that. There's different entities that'll like send candy and care packages over for like veterans overseas, that kind of stuff. So there's different programs that'll intake the candy.
That's a win-win. That's really smart. I love that.
Yeah. All right, well, let's see what we have. So if we only got a 45 participation on the poll, come on, y'all. We're at 50%. Let's go. Let's start talking through a few of these here. So this first one, some feel that the PropTech ecosystem is overcrowded. So if we, every single time you get on LinkedIn, you see these charts that are just full of PropTech entities, and they just get bigger and bigger, and the logo gets smaller and smaller and smaller and smaller because there's like 5 million PropTech companies out there. Do you feel the M&A activity and the outcome of a consolidated list of winners through the economic downturn is a good thing for the industry? And we've got a overwhelming answer here of yes. Paige, what do you think?
I think we are in the age of consolidation, whether we like it or not. In the most rosy of terms, that offers founders exits. That may not be at the face value that was desired or underwritten or expected. But I think in this environment, that is what we are in. There are certain areas in which I think we're deserving of maybe a few less players, where things have gotten proliferated with a few too many point solutions. That also gives someone with a really great idea that's a feature to become part of a platform, where you do one thing really, really well, but someone else does 4 other things. So I think the combinatory effect there is broadly a positive for the industry. Exits are available, and we may not need 17 types of occupancy sensors in a property. So,
Well, and how do you feel about, if I'm a owner, landlord, or even a third party manager, and then one of the big 4, big 5, all of a sudden consumes one of the technologies that I'm using across my entire entity? How should I feel about that?
well, I mean, multiple players is always a good thing. Having like a single, the key man risk of only one company that does one thing. We see that in property management systems. We have several options to choose from. We saw that with acquisitions from JLL Technologies or from other real estate entities that acquired the biggest player. So that was me, knock. So it can drive customers other directions. However, provided that we have enough to run an RFP, if we've got 3 really solid options, that's a good thing. Mm-hmm.
Let's see. Let's talk about the Easter candy one here. So here it looks like, that's what I would vote for, which is Reese's, outside of like the bikini season, which definitely is a category I fit in. Got to keep my keep my figure straight. But for those of you who said cheaps, how dare you? Like, that is like the candy corn of Easter. Like, really sick individuals. No.
Kind of cool to see how they're made, though. I just don't want to put it in my body. Mm-hmm.
No. Nope. All right. So how do we feel about organizations adopting a wait and see approach to halting all PropTech initiatives due to the current market turmoil? So kind of echoes what we were talking about, Paige, where nobody thinks you need to just wait and see and do nothing. Nothing is not an answer. So that's certainly consensus there. Treating everything on a case-by-case basis, which is kind of where I sit with this. And again, I'm going to go back to time to value and ROI, right? If the innovation or the technology that you're looking to implement is going to help you raise your, reposition the asset to where maybe you weren't in the top 10% of market, and it's going to help you raise your rent rates and still get tenants, that's great. If it's going to impact your NOI, if it's going to lower your OPEX or lower CAPEX, those are the things I think are going to get priority. And those have to be evaluated case by case. Paige, what do you think?
Yeah, I've seen different rates of adoption across our strategic investor base. So one global investor has no less than 90 pilots going at this moment.
Wow.
Right. So they're leaning in and saying, we know that this is going to work on one of the properties. We're going to figure it out. Maybe we'll pick a category winner, or maybe we'll continue at the sort of regional level type of influence and chosen provider. So I think slowing down too much means that we aren't prepared for things that come our way, like the pandemic. I think about working early on in some access control, pilots and initiatives. And had we really leaned in there, it would have been a lot easier to figure out occupancy and access and the changes that occurred in the early stages of the pandemic. So I think if the approach is wait and see, sometimes we're not prepared for what's next. So that if we turn the volume down too much, relevancy gets lost. So there's a famous saying by one of the members of my team here, Sam, we call them Samisms. He said, if you feel innovation is uncomfortable, you're going to hate irrelevance.
Agreed. Good wisdom there. And for the audience, I'll give a good example. And if you're interested in this, let me know. DM me after this through LinkedIn, and I'll share it with you. But like QuadReal put out a really good white paper around innovations that they put into some of their real estate around consumables, and instead of being a cadence-based cleaning within their, I think it was like 1 or 2 of their buildings, they went to a demand-based, right? And just on the consumables, not even talking about labor, but just on the consumables element of it, was a drastic, very significant impact on their annual spend just within that one property. So Just off the top of my head, I can't remember the specific numbers, but if you're interested in that, let me know. I can share the case study with you. But that's just a perfect example where it's directly impacting money and spend now. Those are the things that will get priority.
We were able to, on staying on cleaning for a second, one of our companies, Talos, that does the robotic cleaning, has helped eliminate one full-time FTE for janitorial for these sort of like highly carpeted hallways and more so sort of mid-rise or garden style properties. That's entirely possible. Or Vive is a lighting technology that basically guarantees that you have eradicated virus, mold growth, et cetera, in really high traffic or sensitive areas. So I think of our main costs of being sort of insurance, taxes, janitorial, or elevator maintenance contracts out there about how can we really help drive those costs down given the current environment.
Yeah. Let's see, we'll do this last one, then we'll jump into open Q&A. So hypothetical, everyone. So you're an owner that has found an innovative new PropTech solution, had a successful pilot and are preparing for scale. How do you minimize your risk and validate the company you're selecting will be around in a year? And I think we touched a bit on this earlier on in our conversation, so this might be a bit redundant here. But we have kind of a split between slow roll your deployment, right, and be a little bit more methodical. And then another one is just doing your months of due diligence on their financials, which that's, assuming you can even get financials, right? You get a lot of privately held companies that you're just not going to be able to get that. And as a buyer, it's up to you whether or not you trust that company enough to move forward. I think Paige had a tremendous point earlier, is if you open up and look at your peers, right? And are your peers adopting that technology? Are those peers going long on that technology, which is going to help solidify what the financial stance is of that organization? I think you can start looking at those things, but it's a tough question, right? Anything you would add to that, Paige?
I would add a couple things, because this year alone, Modern has helped launch 15 pilots, with our portfolio on one end being the technology companies and the other side being our industry partners. So with those pilot launches, I would say making sure that you have picked the right sandbox. And sometimes that goes with building the right innovation team structure and making sure that maybe you're not overworking the people who continue to raise their hand for new technology, because you tend to have the same recruits. And how do you incentivize innovation across an organization is really critical to making sure that you're not piloting in the same property every single time. So pick your sandbox correctly. Spread that opportunity and reward that innovation at the organization level. I would say two things I would add to it.
Yeah. Well, and a lot of what we do is working with different companies, and it's not just different point solutions, but now we find that there's a significant trend, especially from C-suites and organizations that are strictly looking to buy outcomes, right? And those outcomes may encompass several different technologies. You had mentioned smart cleaning, right, which can that encompasses several different technologies to enable that entire user journey and end use case for whatever property that goes into. But it's almost we find ourselves curating ecosystems for organizations that are looking to buy specific outcomes or groupings of outcomes for one property, multiple properties, and really being an ecosystem provider. Because once you get into trying to enable these use cases, you have over complexity, you have different throats to choke, right? It becomes very convoluted. And so we find ourselves kind of being an orchestrator of those things, consolidating that, removing that complexity on behalf of owners, and getting that end result. So a little bit of a different flavor on that, but let's go ahead and open this up to live Q&A. So I'm going to go ahead and pop that open. And so far we've got one. For anyone, if you did not hear earlier, we're doing live Q&A at this point. So if you have anything specific you want to ask Paige or myself, now would be the time. Let's see. This one says, we hate that as a developer, then we are locked into a big player and we feel hosed. So I'm going to assume this is looking at some of the larger OEMs that are, I don't want to name drop anyone in particular, but, kind of have the larger players, the OEM players that, put you in a situation of vendor lock.
may have been also about sort of competition and it being in the era of consolidation as well. That if consolidation or you go too long on one single provider, then you're really without a backup.
Yeah, this gets into ensuring that whenever you're selecting technologies that you're validating a couple of things, right? You want to make sure, and we go through this process that's OC&S, and when we do site assessments or we're evaluating any technology on behalf of any of our customers, is making sure that whatever technology you do select is that they're opened, they're connected or converged, they're normalized as far as the data and the open protocols that they utilize. You need to make sure that, if the company is saying, well, we have this amazing API and it integrates with anything, the second you say API, that doesn't mean open, right? Because a lot of times those APIs means that you're paying a toll to transfer data, right? You need to make sure that data portability is there. And you also need to make sure that those technologies are secure, right? So that's kind of the open, converged, normalized, and secure methodology that we take when helping customers evaluate specific tech. Paige, you have anything you want to add to that?
No, I think we hammered it home. Like it.
Any other questions out there before we wrap up for the day? All right. Well, I'm going to share one last thing for everybody. So, as I mentioned earlier, I've had the pleasure of knowing Paige for quite some time. She is a delightful individual, and if you've not met her before, it's not too late. So here is some contact information. If you're interested in having a discussion with Paige, whether you're a PropTech organization who's looking for insight, looking to make a deal, Paige is an amazing individual to get in contact with. She's just a great industry individual to know all around. If you're interested in chatting with intelligent buildings, if you have any initiatives that you're looking to achieve and you need some technology experts in your corner, we'd love to have that conversation with you. I also want to invite the audience next month on our episode. We'll have Emmanuel Daniel, who is the principal product management leader at Microsoft. He's now kind of running their data center practice. I'm going to have him joining us. We're going to be talking about curating delightful experiences for the workplace. So that is going to be on May 18th at 2 Eastern. We definitely would love to have you join us. So make sure that when we post the invite for all of that, that you're registered for that and you'll be able to join us next month on the 18th. Paige, you're an absolute delight. Thank you so much for joining me today.
I'd encourage the two questions we got here at the last moment. I'd encourage you
Oh,
to
did some other ones pop through?
Yeah, I love them though too. And coming from having sat on the side of one of the largest private real estate owners in the world, there are specific conversations to have with lenders or even capital partners about what you want to do with an asset and really pushing the envelope from an innovation standpoint and how you get credit for it. I think about trying to encourage lenders to underwrite our co-working revenue a little bit differently and count that toward NOI, even though it was deemed less secure than a long-term lease. So there are some really sort of specific feedback I would have here, mostly on the corporate real estate side of this puzzle, as well as a second question about how to communicate your roadmap to large corporate owners as a startup and really stick to it, because you're only as good as your word, and that really matters, especially on the roadmap question. So would love to hear from y'all.
Yep. All right. All right, everyone. Well, again, thank you for tuning in today. Hope you'll join us again next month with our chat with Emmanuel Daniel. Paige, thank you again for joining us today. You're amazing. Look forward to seeing you in June in Las Vegas. So hopefully for those of you that are tuning in, you're going to be joining Paige and I in Las Vegas for RealCom as well. So thank you, everyone. Have a wonderful day.
See you soon. Thanks, all.